We are halfway through the year, and if you have capital deployed in the Indian stock market, you are likely watching a tug of war. Domestic growth remains supported by strong consumption, but external pressures are actively pulling at the edges. Market sentiment is reacting to shifting inflation trends, broad global uncertainty, and extreme volatility in crude oil movement. Because these macro forces silently affect your wealth behind the scenes, asking how much return did my portfolio generate is the wrong question right now. Over 6 months of fluctuations, a balanced asset allocation silently deforms into portfolio drift. As equity rises sharply, that slice swells, displacing other assets. Consequently, your portfolio's risk profile increases, pushing you past your planned risk. That is why a mid-year review should never be treated as an emergency response to a market drop. It is a necessary objective checkup to identify and correct this invisible drift. The first step in this checkup is measuring performance without emotional bias. A frequent mistake is comparing your entire portfolio against a single highest performing stock in the news cycle, which only creates irrational dissatisfaction. This side-by-side comparison shows the correct approach: contextual benchmarking. Here, a rupee-denominated hybrid fund is measured strictly against a blended benchmark index. An equity fund must be judged by an equity index, and a debt fund by stability metrics. You also need to identify the exact cause of any lag. There is a strict difference between temporary underperformance caused by short-term market cycles and structural underperformance, where the original investment thesis has failed. Isolating the context behind the numbers prevents emotional decision-making and ensures your overall strategy remains disciplined. That discipline starts with asset allocation, the deliberate division of your capital across equity for growth, debt for stability, gold for hedging, and cash for near-term liquidity. Over the last 6 months, your allocation has likely shifted involuntarily. Domestic interest rate policies, recent foreign outflows, and rupee weakness driven by corporate dollar demand have all skewed original portfolio weights. This diagram shows the mathematical solution: rebalancing. Rebalancing is not a panic exit. It is the calculated process of taking rupee profits off an overperforming equity column and redistributing them into the debt column until all assets align with your target line. Rebalancing is your ultimate defense mechanism. It actively reduces your dangerous overdependence on a single volatile market trend. Market data is only half the equation. You must also audit your personal timeline. Capital needed in the next 1 to 3 years simply cannot carry the same risk as retirement funds you will not touch for a decade. You also need to calculate the stealth impact of inflation. The future target cost of your education, healthcare, and lifestyle goals has likely increased since you first set them. This requires you to mathematically verify if your current monthly systematic investment plan, or SIP, is still large enough to bridge the gap to those revised goals. A mature investor does not blindly chase arbitrary returns. A mature investor explicitly connects every single rupee deployed to a defined future outcome. To reach those outcomes, you have to confront the psychological trap of risk. Many investors feel highly comfortable over-allocating during bull markets, only to panic and sell during sudden corrections. This line graph tracking mutual fund inflows illustrates this perfectly. Notice the steep drop in May 2026. When global uncertainty hit, investor confidence fractured rapidly, leading to a sharp decline in inflows. Before continuing your long-term equity exposure, audit your emergency funds and evaluate your true comfort level with severe market fluctuations. Proper risk management does not mean fearing equity. It is the exact calculation of how much volatility your specific financial plan can endure. Let's put this into a mid-year checklist. First, review your returns against contextual benchmarks. Second, verify your asset allocation. Third, audit your SIP sufficiency. Fourth, identify overlapping assets. Fifth, rebalance gradually without panic. And finally, ensure every single investment maps to a specific goal. Global events, corporate earnings, and crude oil volatility will always cause market chaos. A well-calibrated portfolio relies solely on your internal discipline. No one can predict the market's next move. Regular, objective diagnostics are the only way to ensure your investment strategy actually reaches its destination. Stop guessing and start realigning. Connect with your relationship manager at GEPL Capital to review your portfolio and keep your financial goals on track.